In today's episode, we're going to talk about how GameStop as a corporation is rewarding its shareholders, especially the loyal retail traders like you and I who've been buying up, trading, and investing in shares of GameStop over the last several years, helping, by the way, keep GameStop relevant during a period of time which other brick and mortar businesses with a legacy business model have struggled, including Bed Bath & Beyond, which is in bankruptcy. Now, GameStop has rewarded us by giving us the distinct honor and privilege of looking like a bunch of idiots. They have made us look like what the media portrays, dumb money. And I'll tell you exactly how it happened. So about a month ago, GameStop shares hit $80 a share. Now remember, they did a 4-to-1 stock split in the last 2 years, which means $80 a share is the equivalent of $320 a share back in 2021 numbers. So that means at that moment, the market cap of GameStop was in excess of $20 billion. That's billion with a B. Who is a $20 billion market cap good for? It's good for the shareholders, for all of these loyal retail traders who own just a little piece, a little sliver of this company. And many of us were rejoicing. Not only were we excited about the possibility for a short squeeze, we also knew that if we wanted to take a little profit, we had the opportunity to do that. What did GameStop do? They promptly sold 120 million shares on the open market, and they tanked the price of their own stock. This is unbelievable. So this is the topic of today's episode, and we're going to start by taking a look back because the market cap of GameStop in 2020 was just $250 million. This is when Roaring Kitty took his first position. Part of his thesis was that he believed that the risk associated with digitalization was overblown for GameStop, number one. He thought bearish sentiment was overdone, and he believed that there was a better than 0% chance that GameStop as a company could turn things around and transform the business. He thought that the equity was worth at least $250 million, and he was right. Now, at that time, there was about 50 million shares available to trade. That was the float. And it was trading at about $5 a share. So about $250 million market cap. Fast forward a year later, 2021, retail traders start buying up shares of GameStop and the market cap balloons to $5 billion. And that was just when it was priced at $100 a share. When it was priced at 200, 300, 400, for a moment, we were back at that $20 billion market cap, which is absolutely incredible. Now, they did an offering in April of 2021 and again in June of 2021, but these were not huge offerings, relatively speaking. So in April of 2021, GameStop completed a secondary offering of 3.5 million shares. They raised approximately $550 million. And then in June, just a couple months later, they sold another 5 million shares and raised approximately $1.3 billion. Okay, so in 2021, they raised a total of about $1.5 billion. And that's good. That's cash that goes on the balance sheet. That is good for the company because they're able to use that money to pay off long-term debts. So now they're structured really well. Now, we'll talk about Roaring Kitty's thesis and how that $1.5 billion helps it play out. So let's take a look here now at the market cap in 2024. So I'll hide my video here just so you can see this whole thing. Market cap in 2024, the float prior to Roaring Kitty's return to social media was 305 million shares. Now, the reason that the float had gone up so much was because of the 4 times split. So the price goes down, divided by 4, the float goes up times 4. So the float was higher at 305 million shares. And the market cap was about 5 billion. We were holding that $5 billion level, which is pretty impressive. The current float is now 426 million shares because they sold 120 million shares on the open market. And the current market cap, well, it's 426 million times $25 a share. It's currently about 10 billion. But the problem is they increased the float by 120 million shares, which gave them $3 billion of cash. So realistically, it probably makes more sense that their market cap is closer to 8 billion. 10 is a little high right now, just based on what's happened in the last, 2 months. Now, I want to pose this question to you. How would we feel if a hedge fund came in and shorted 120 million shares of GameStop worth $3 billion. We would be furious. We would be so upset, right? We'd be like, whether it was Citadel or whoever it was, we would be outraged. But that's kind of what GameStop did. They dumped shares onto the market. They printed shares, they dropped the price, and although that money is now on their balance sheet, it feels like they took the money right out of retail traders' unrealized profit loss and just moved it right into the company itself. And so for retail traders who've been loyal to this company, who have helped keep the company relevant, I think it's a huge insult and extremely disappointing, especially compared with the fact that had they not sold these shares, well, let's think about this. Prior to the offering, we had 305 million shares at a price of $70. That's a $21 billion market cap. So the market cap easily was cut in half because of this offering, but possibly more depending on what happens in the future. Now, here's the thing that's tough for shareholders. Shareholders are not required to vote on a secondary offering. Secondary offerings can be conducted as a decision by the board of directors and as per filings that have already been made with the exchanges, or with regulators. So this is part of the filing that was made, and it shows that their charter authorizes them to issue up to 1 billion shares of Class A common stock. So as of May 4th, there were approximately 306 million outstanding, but as we know, they did sell an additional 120 million in total. So from $1.5 billion raised in 2021, they were able to pay off long-term debts, which is great. They had a new console cycle, the new video games that were coming out in the fall of 2020. They had the new console cycle with new games and everything else that was going on. And Roaring Kitty was right that the risk of digitalization in the effect that it would have on the business in 2020 and 2021 was overblown, because digitalization and the adoption of moving just to downloading games has been slower than expected because of how big a lot of these games are. People would rather have them on disk rather than take up all the space on their hard drive. So he was right in that regard, and GameStop has been able to keep its head above water, more or less. But over the last 3 years, what has happened? We've got the new console cycle. We have new leadership. They raised $1.5 billion. But when we look at the metrics of the company, what we see is that their gross margin has declined. Their free cash flow has declined, and their annual total revenue has also declined. So now the one thing they have going for them right now is the equity. The equity was about $1.3 billion in January of 2024 before this most recent offering. They sold $3 billion worth of stock, which means they now have equity because of this cash on hand that is really, really good. Their debt is mostly paid off. Mostly long-term debts are paid. And so they've got this great cash position here of about $4 billion. That's a huge amount of money. But their actual business, the actual operating company of what they currently do, the legacy business model, well, what we know from the latest earnings, which were released about 2 weeks ago, is that sales were down, gross revenue down 29% year over year for Q1. That's 881 million versus 1.2 billion. That's not an insignificant amount of money to be down in terms of gross sales. They also have declining free cash flow. In fact, they're operating at a loss. So the cash that they have on their balance sheet is not cash from running the company. It's cash from selling shares. So declining revenue, I mean, they're not positioned super well. The gross margins have decreased. And this is something that Roaring Kitty talked about in his videos in 2020. He was saying at that time that, look, I think that the sentiment is overly bearish because the company is maintaining their gross margin. When a company starts losing its gross margin, that's when you have to be careful. So in January of 2018, 2019, and then 2020, their gross margins were still solid. Well, look now. The gross margins are declining in 2021, 2022, 2023, and 2024. So they're low, historically low compared to the last 10 years. We're back to the 09, kind of level here, which although it did give way to a nice move here where they increased, this was during a period where the risk of digitalization really wasn't there. But now it's even higher than it was in 2020. Okay, so we also have short interest, which we know at this point right now represents about 14% of the float. So the short interest doesn't appear to be very high, although it's true that through equity swaps, there may be higher synthetic short interest that is not reported and we're not aware of. We're not able to very accurately tie down what that number is. So there may be higher short interest than we're aware of. And one of the things that indicates that could be the case is that the short volume is higher. So this is the total number of shares traded to the short side. But I would argue that this is in part because GameStop is currently easy to borrow. It's easy to borrow, which means brokers have made this stock, they're lending out the shares that you own. So unless you're doing direct registration of your shares and taking them off the exchanges, or you have specifically told your broker not to lend out your shares, by default, they are making your shares available so other people can short your shares, which to me is like, why would you want any broker to do that? Why would you want them to lend out your shares? Because if other people are shorting the stock that you're holding long, that's going to hurt your position. I mean, unless we get an epic short squeeze, but those aren't as common. And what we know about naked short selling and some of the practices that these big hedge funds engage in, they have ways of just pummeling these stocks to the downside and crushing them. And as little retail traders, there's not much we can do. And this feels like another example where the little guys, us retail traders, are getting the rug pulled out from underneath us, both in the form of the offering, but also in everything that's gone on with short interest and with high levels of potential short volume. We don't know exactly what the actual accurate short interest is. So we've got high degrees of short volume, in fact, higher than it's ever been. This was the 2021 level right here. So you can see we're clearly higher. And if we look at the actual platform right here, you'll see that GameStop shares today are down 2.5% as of right now. And E right there means it's easy to borrow. So you can easily short this stock. You don't have to pay a fee. It's free to short it. Why are they making it free to short? Right? And this is something that a lot of people are asking about. It doesn't seem to make sense. So now, over the last 3 years, GameStop has done 4 offerings, and they've raised approximately $4.7 billion. So we have the offering in 2021 in April, the second one in June, which we already talked about, and then May of this year, they completed an at-the-market equity offering, and they sold 45 million shares over the course of like 4 days, selling heavily, and they raised $933 million. Now, when we look at the stock of GameStop and we look at the days where they were selling these shares, it's really unbelievable the degree of selling that was going on. So let me show you right here. So this is right here where the selling began of the last offering. The selling began right there. And you know where it finished? Right here. So look what happened to the stock as soon as the offering finished. It went from like $24 a share up to $32 a share. When you don't have this just continual selling pressure pushing the price down, the stock goes up. Isn't that funny? So basically what they did right here was, this was the morning that Roaring Kitty was going to do his live broadcast at 12 p.m. right here on this day. And they came out with a news early earnings release that the company was down 29% year over year in sales, and that they were doing a $75 million share offering. And the price immediately goes from $60 down to $32. Roaring Kitty at this moment right here had an unrealized P&L of, I calculated it, it would have been his account total value over 900 million. He was almost a billionaire right here. And then GameStop shot him in the foot, right? I mean, it's not his fault. I guess the only area that he has fault is taking the risk that they wouldn't do this. When you take that big of a position, there's a chance they could, and they certainly did. Now, if we go back to the previous offering that they did, this one was back on the 17th right here. So we got the news. Let me just check the filing. So let's back out of this. So the last one, the filing was on 5/17. So it was on May 17th that we got this filing here. And I think they closed it on the 24th. So let's look at the 17th. Okay, so 15, 16, 17. There it is right there. So that was when the drop began. And by the 24th, they had closed and finished the offering. So they finished it. It was, I think it was right here. Yep, right there. They finished the offering. And as you can see, the price goes up. So during this period right here, while retail traders are still actively buying and selling GameStop, the company itself is selling into all of these pops. Selling, selling, selling. Now, they do it through an investment banker. And by the way, the investment banker gets compensated for their role in helping sell these shares. They make millions and millions of dollars. And all they have to do is just sell, 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 sell. They press the sell button about 500 times. They dump a ton of shares onto the market. They raise $3 billion, and then they make, millions of dollars as their commission. Again, this is big money, and big money always wins over retail. That's why they call us dumb money. I hate to say it, but I feel like they kind of proved, and it's not that it makes us honestly look bad. We're dumb in the sense that we're maybe blissfully ignorant, that we're hopeful that this type of stuff won't happen, right? It's almost like we're naive because we think, oh, this stock's gonna go up. And then all of a sudden the sharks come out and they just eat us up, right? They eat us alive. And I want you to think about the fact that Roaring Kitty lost $700 million in unrealized profit. That is an insane amount of money. I don't know how anyone could cope with losing that much money unrealized. Now, we all know that Elon Musk has made the record of losing the most money, I think, out of anyone. I think Mark Zuckerberg was before him, but it's to the tunes of going from what was Elon Musk's peak net worth, like 300 billion or something, and it went down to like 180 billion. So yes, he lost a crazy amount of money, but one could argue that how much does your life change when your net worth changes from 300 billion to 180 billion? You're still a billionaire. Like, probably doesn't change. For Roaring Kitty, the difference between 200 million and 1 billion, I think that's a lot more significant. I think when you're in that realm, it's really significant. The difference between 1 million and 5 million, these start to be really life-changing. And I think there's a lot of retail traders that had life-changing amounts of money invested in GameStop. And now I'll be fully transparent that I did not. I did not have life-changing amounts of money invested in GameStop. And although there was part of me that felt FOMO, I'm too risk-oriented to take those types of YOLO trades. It's not something that I've ever done. And so, for better and for worse, I didn't make, crazy money in 2021. I didn't make crazy money here on this last wave, but I've just been slow and steady, consistent, because that's the way I trade. Now, everyone's different. And, I don't fault you guys who took more risk and who thought, this had the potential to really do something exciting, because, I don't think that you were wrong in looking for that or hoping for that, especially based on what we had, if we, of course, recall back in, 2021. But the fact is, what we got as a wild card was the company itself dumping shares onto the market. And like I said, if that was an individual hedge fund that was shorting on the open market, we would have been furious. Okay, so May of 2024, we get the 45 million share offering. They raise almost $1 billion. It's crazy. It's like just so much money that they could just kind of at any time say, you know what, let's sell another 45 million shares. Let's raise $1 billion. Then June of 2024, they said, let's do it again. Let's sell 75 million shares. They raised $2.1 billion. And so I think naturally there's a question here of what will they do with the money? So many of us have been eagerly awaiting, like, what are they going to do with the money? And I think another question is, will they do another offering? Like, I mean, not for nothing, but they just sold 120 million shares of this company. They raised $3 billion, and the stock is still trading at $24 a share. What if they raise another $3 billion? Would the stock hold at 10 or at 15? Like, literally, how much money could they raise? Could they raise 10 billion, 50 billion? Like, at what point do they just hammer it till it's like, there's nothing left, right? I mean, they don't want to do that, But at the same time, they didn't have a problem raising $3 billion here. And so the question is, well, what is the money for, right? Why did they choose to raise more? Was it just because they could? Because you could argue that they could still do another offering here. Like, why not, right? The price is $24 a share. They could sell more shares. They could sell it, maybe just keep selling until it goes to 20. Anytime it goes below 20, they stop selling, let it come back up. Comes back up to 25, 26, they sell more, let it go back down. They could do that. They could raise another billion, a couple billion, who knows? So the lack of understanding what they need the money for and what they're going to use the money for is what I think is upsetting for a lot of retail traders. Because what ends up happening is, and this is true for Roaring Kitty. So he owned a little piece of the pie here, which is currently 2% at 9 million shares, right? So he owns this piece of the pie. But what the company essentially did was like, hey, let's just add, this much more pie to the pie. And your percentage now, well, it would have been 5%. I think at 17 million shares, it was going to be like 5%. But then, it ends up being a smaller percentage because they sell more shares onto the market. Now, he didn't do 17 million shares. He only has 9 million. If you recall, when he took his initial position, Roaring Kitty bought 120,000 calls, and he also bought 5 million shares. So if I pull this up here, we'll see his P&L. So his P&L currently is 9 million, but the last update was 5 million shares and 120,000 calls. If he had sold these or exercised them, he could have had 17 million shares total. And at this time right here, when his account was at 586 million, the next day is when the stock price, this was when the stock was at 46. The next day it went up to nearly $70 a share. And that was when he was up 900 million. That was crazy money. And I feel frustrated for him that, the company did this offering. I don't feel too bad for him. He's still got $200 million, but I feel worse for the retail traders who put everything into it, hoping for a big win and got smoked. That's going to be a lesson on risk management for sure. But it's hard to see that happen. So in any case, he's got 9 million shares. Even Ryan Cohen, his stake has been decreased down from, I think, at high 13% down to about 8%. Because look, they had a float of 300 million shares here, and now they add another 120 million shares. So you've got a combined float of 425 million shares. So you've increased the number of shares available by like 30%, right? So everyone's percentage has been diluted by that same ratio. And this is kind of the problem that honestly people have had with the US dollar, that with the US dollar, the Federal Reserve can just print money, just print money, put it into circulation. It devalues the dollar. Well, how is that different with shareholders? And for us, when the company prints more shares, it devalues our position. And to be honest, it would make me feel really insecure to be holding shares of a company where I was worried about the dilution. I would rather own shares of companies that I don't think are going to do offerings. But nonetheless, okay, so they now have $4 billion of cash. So during the shareholder meeting, this was just on Monday, they have a shareholder meeting and it's 16 minutes long. Now, some people are like, short and sweet, that's how they always do it. Short and sweet meeting, they get to the point. Ryan Cohen made kind of an early speech at the very beginning of the shareholder meeting. It was brief. It was like a paragraph long. And let's see if I can find it here. Let's see. So Ryan Cohen speech, shareholder meeting 2024. So his opening remarks, this is what I'm looking for. So his opening remarks, so he says, "Hi, Mark. Thanks, everyone. I want to take a moment to discuss the retail business and the future of GameStop. With respect to retail operations, we plan to continue reducing costs and focusing on profitability. Revenues without profits and prospects of future cash flows are of no value to shareholders. This means a smaller network of stores with an expanded assortment of high-value items that fit into our trade-in model." And, you're like, okay, so they're going to continue to focus on a smaller network of stores. Now, what we know from their earnings and from looking at their financials is that the company is, they're currently operating at a loss. So if we look at GameStop here, this is Guru Focus, which you have to subscribe to, but they've got a ton of data here that you can just tore through. So when we look at this, what we know is that, we just look at revenue's declining, right? We know the gross profit margin is declining. So we look at the equity. I mean, we can see that they're in a period right now where they're struggling. And if you look at some of the similar meme stocks like AMC or Bed Bath & Beyond, these ones are, well, certainly Bed Bath & Beyond is worse, and AMC is in a very difficult position. But the fact that, let's see, free cash flow, where were we here? So not per share, but just total free cash flow, you can see they're operating at a loss right here. They're not producing free cash flow. So anyways, having a strong balance sheet, especially in terms of economic uncertainty, I'm reading what he said, is strategic advantage. While the future is always uncertain, the last decade's monetary and fiscal policies, both within the US and globally, are historic anomalies. Exiting from an ultra-low interest rate environment is likely to have unforeseen reverberating effects across the economy, as seen with inflation hitting a 40-year high in 2022. Right, we know that. Under current interest rates, an investment made in today's economic climate must bear a higher return threshold. And he's right about that. So this is 100% true. He said, as my father always said, actions speak louder than words. We're focused on building shareholder value over long term. We're not here to make promises or hype things up. We're here to work. Thank you for being a shareholder. And I think that that's interesting. He says, we're not here to make promises or hype things up. We're here to work. So I think the thing there that I find interesting is that when you think about CEOs of these companies that are in the spotlight, I think of like Apple. And I think of Steve Jobs and Tim Cook making these keynote speeches, and they are hyping people up. They're trying, it's their obligation as the CEO to sell shareholders to a certain extent, of course, honestly, on the prospects of the company. They have to be the company's biggest cheerleader. They are the leader of the company. So I kind of feel like if a company is going to raise $3 billion, I want to hear, give me the spin on what you're planning on doing with that money to help turn this company around, to transform it. You know what I mean? That's just me. And maybe that's silly that I want that or expect that, but that's what I would look for. And we're not getting that. It's like, we're here to work. And I'm thinking, okay, well, but when you say that, let's look at what the actual, metrics are reflecting of the work. Sales down 29% year over year. Operating at a loss, right? Legacy business model. So I'm not seeing, based on what's happened in the last 3 years, and that, remember, they did an offering in 2021. So they've had now several years with this cash balance, and the result is, well, this is where we're at. Year over year, first quarter down 29%. So what's happening to turn the ship around? What's happening to transform the company, to make it more profitable? How is shareholder value being created? Because with these offerings, shareholder value is being diluted. So I hope that we see this turnaround. Now, when it comes to, will we see an epic short squeeze on GameStop? At this point, you now have a 425 million share float. The float is huge. So there's a crazy big amount of supply. And I don't think there's going to be the imbalance between supply and demand that's going to send the stock up. Think about in 2021, all of the people who bought. At that time in 2021, the float was about 50 million shares, 50 million shares in 2021. So now the float is 10 times bigger, nearly 25 million share float, 425 million shares. So with the float 10 times bigger, you would in theory need 10 times as much volume as in 2021 to get the same imbalance between supply and demand. Where's all that volume going to come from? It's not going to be from retail traders. There's not enough retail traders out there to create that kind of volume. So to be honest, I don't think it's going to happen. In fact, I think Roaring Kitty's best bet, if I'm going to be really honest, is probably to look for deep value in a different stock somewhere else in the market. Because I think GameStop, he squeezed as much as he could out of it, and he went for that last move, and I think they kind of burned him. And I think they kind of burned a lot of retail traders, which is why I feel like we've been made out to kind of look like dumb money. And, I feel kind of stupid, and I feel kind of silly and disappointed. And it's like, who won? Big money again. The investment banks, they won. They cashed in on this with, the commission that they make on the offering. GameStop won. And maybe shareholders will win long term if the company's able to use the $4 billion that they have right now to turn around. And they might. They just might. But I'd love to hear the story and the plan of how that's going to work. What's it going to look like? And until then, we're just left asking questions. So thanks as always for tuning in. If you enjoyed this episode, I hope you hit the thumbs up, and I'll see you for the next one real soon.